All right, guys, welcome back to another episode of Sky's the Limit podcast. I'm your host, Mike Doherty, and today we have Gary Jonas, who's the owner and CEO of the How Group, which is a one-stop shop investment firm. They have 500 million assets under management. Very impressive. They do all things from raising capital for their deals to for their investors, property management, and continue to grow their portfolio. So, with that, Gary, welcome. Thank you for coming on the show here.
Absolutely, my pleasure. Always like talking to fellow real estate people.
Yes, yeah. So where is the How Group located? Where are you guys from, and where are you currently investing?
Yeah, so we are a Philadelphia-based company. Um, all of the assets that we own are within the five-county Philadelphia submarket or MSA, as you would kind of think of it. Right now, that's our main focal point from an investment standpoint. We know the market, we love the market. There's enough opportunity there, so we're kind of laser focused on that market.
Yeah, no, makes sense. And how the heck did you get started in real estate investing? Obviously, one doesn't go from, working a W-2 job to 500 million assets under management. So can you take me through the journey of when you kind of first started, interested in real estate to where you are now?
Sure. Favorite thing to do is talk about myself. So here we go. Um, so I graduated from college in 1992. And when I did, the first thing I wanted to do was buy a house. So I graduated. I was lucky enough that my parents paid for me to go to school. So I had no debt when I graduated, which was really, really helpful. And so I was able to stay at home for a year and a half, save up some money to put 3% down on buying my first house. And, when I did that, I thought, man, I've made it. I'm the first person I know that bought a house. So this is, the definition of success. I had two roommates that moved in with me. They were guys that were friends of mine from college. 6 months later, they both moved out, moved in with their girlfriend, got a new job. I had to move out because I couldn't afford the whopping $500 a month mortgage payment that I had at the time. And so I moved back in with my parents and I rented that house out. And when I did that, the guy that rented from me drove a Porsche. Um, and I thought, man, this is a pretty good gig. I need to do more of this. How do I come up with a system to buy more houses? And my grand plan, Michael, was I'm going to buy 10 houses and I'm going to pay them all off by the time I'm 45 and then I'm going to retire. This is my plan. Okay.
Love it.
And so nothing grand. It was like, hey, save up enough money to buy one house a year. And then, as once I got up to 10, start taking the money I was making from the properties and pay down the mortgages and 45 retire with what would have been the equivalent of $150,000 in income at the time.
Simple living.
Simple living. And I explained to people because I bought four or five or six houses. And at that point, I was in the mortgage business. So when I got out of college, my second job, I ended up working in a call center for a mortgage company. So I was able to make some money doing that and, didn't live a big lifestyle, was really focused on buying a house a year, saving up enough money to do that. My expenses were next to nothing. And I was able to kind of cobble that together and buy those 10 houses. Um, and I did that. And then I started working really hard. I was, again, making money in the mortgage business as a W 2 employee. Then I decide, hey, I'm working really hard for other people. I should try my hand at opening my own company. But I was never kind of a go it alone guy. So me and three guys that worked together essentially decided we were going to go out and try and start our own mortgage company. And it was so long ago that we were putting ads in the Sunday newspaper that said like, hey, our mortgage rate is this. And people would call and we would put them in touch with realtors and help them buy houses. And so we did get some connections in that industry, but we happened to get involved in the mortgage business and start our own company at the right time where that mortgage business really kind of took off. And then my partner said, hey, we'd like to start buying some real estate. Why don't we look at whether we should start buying some real estate together? So we sat down as a partnership group and we said, okay, well, who's generating the least amount of revenue here in the mortgage business? And at the time, it was my partner, Andy. So he said, all right, Andy, you go out and buy real estate for us. And the three others of us will work really hard in the mortgage business to generate enough money to pay us so you can buy real estate, because real estate doesn't make money the year you buy it, doesn't make money 2 years after you buy it. It's a process to buy it, to fix it up, to get it cash flowing. Like that takes a little bit of time. So the fact that the four of us were generating income that we could live off of, and Andy could start to build a real estate portfolio, was kind of what the plan was. Now the question was, where were we going to get the down payment money to do this, right? And what we decided to do was take, at the time, we could take lines of credit against the 10 houses that I owned, because I had built up these 10 houses over 5 or 7 years. And we took these second mortgage lines of credit out of that against them, which totaled roughly $500,000. And Andy's job was to go out and find places that he could fix up and then hopefully get our cash back out of, and we could buy, two or three a year by doing that process with him doing it full time. And then what happened is we got really lucky in that we found that Temple University, which is in Philadelphia, was expanding. I think it was the second biggest university in Philadelphia, but it just didn't have enough housing. And there happened to be a lot of land around the university because it was in a rough neighborhood. And so we were able to start buying these lots and building duplexes. And we were building these duplexes, with Andy running it. We were building them for $250,000, and they were renting for $4,000 a month. And
Wow, nice.
the taxes were nothing. So all of a
Good.
sudden, we finally started making money on real estate, and it was like, wow, this is great.
Yeah, it's a quick 2% rule right there. It's hard to find these days.
Yeah, correct. I couldn't find it today if I wanted to,
Yeah,
and
right.
those properties probably made us more on a per dollar basis than anything we've ever owned.
Do you still own those today?
We don't, and the only reason we don't is once we started building there, and a bunch of other developers came in, and now all of a sudden there was this kind of huge buildup of off-campus student housing, and the kids weren't acting as responsible as you would like to see them act. Let's just say they had these enormous 4-bedroom units. They're partying like crazy, and so me and three or four of the landlords tried to create what we call the business improvement district, and said, hey, let's tax all the landlords in this area and pay for some security, pay for some street cleaning, pay for some things, because we created this unintended consequence, and it's not good for the neighborhood. And I don't feel good about making money if the neighborhood's worse than it was before I got there. And so we got the city council person to submit a ordinance to do this. And the neighborhood said, something can't be right about this. These landlords want to tax themselves. I don't buy it. And they turned it down. And when they turned it down, I said, look, I don't want to be here if we can't control this. And we can't, we're trying to do the right thing, but the neighborhood doesn't trust us, for whatever the reasons are. And we sold our properties down there and started buying in other areas.
Got it. Okay. Interesting. I'm surprised it's almost like too good to be true. Why would they want to do this? And they probably just didn't dig into too deep as far as why you guys actually want to do it. So that's interesting though. But I love the story how I think, or like you grew to where you are now very organically, right? It started with some smaller multi single family housing, and then one thing led to another. You started growing. You took out the second lines of credit. I'm always a big proponent. David Ramsey talks about zero debt, and I agree with him for some people that aren't like financially sound, I'd say. But using bank leverage to grow to a position where you are now is probably the only way you could have got there, unless you're coming from a boatload of money or inheriting money, or you have some really, really wealthy partners. You have to leverage some other assets. So doing so prudently, I think, makes a great deal of sense. But a lot of people kind of get caught up like, oh, I got to pay down, if I have one house, I got to save up enough to pay down that mortgage entirely. And I sleep better at night knowing I don't have a mortgage over my head. And I totally respect that. But how many properties do they ultimately own? Right. And can you really exit the game, the rat race with just one or two? I think the answer is no.
The answer is definitely no. And look, when I have these conversations, I feel like we've attained a certain level of success. And if I were trying to lay out a roadmap for people, here would be my roadmap. Okay. And it depends on when they're starting. Okay. If they're starting and they don't own any real estate, I would say the first thing to do is to buy up to a 4 unit property if you can find it, right? If you can find a 4 unit property, you can still get an FHA loan on it. You can still put 3% down. You can get a whole bunch of first time buyer type of credits. And now you're buying 3 other units where people are paying you rent and the unit that you live in, right? Like I'm starting from scratch tomorrow. I own no real estate. I save up enough money to have my 3% to buy that. Okay. And that's my base to get started.
100%. Yep.
If I, I'm married, I got a couple kids, now I'm getting into it. I already own my primary residence, and now I want to buy my next property. Then I would probably recommend buying a single family property because that's going to require the least amount of capital out of your pocket, right? And what we know about single family properties is they appreciate in value more than multifamily properties as a rule of thumb. So while you might not get great cash flow out of the gate, if I thought I could buy a single family house every 2 years, let's just say, it took me 2 years to save up the money to buy one. I bought one. 2 years later, I can buy another one. And then I get two or three of those over 5 or 6 years, right? Now I've built a ton of equity in them. Now I'd probably sell those and go out and buy a 6 unit building or a 10 unit building with the equity that I created in them. Because to save up enough money to buy a 4 or 6 or an 8 unit building, when I'm married, I got some kids, I got, like that's a harder thing to get to because the amount that you have to put down. So my
Exactly.
strategy would be totally different depending on where I was in the cycle.
Yeah. And the cool thing about real estate, as we know, is when you go to sell those single family homes and scale up, you can do a 1031 exchange and defer all those capital gains. So, you can use all of those gains as a new down payment almost. If you do it right, you don't ever have to come back out of pocket. You just keep scaling up, bearing that those houses are appreciating. No, it's a great strategy. It's how I got started. Bought a duplex, lived in 1 unit, was making okay money at a W-2 job, and didn't have a huge mortgage over my head. The tenant was paying majority of the mortgage, and then just kept buying the multis and scaling up and scaling up. And don't have a $500 million portfolio, but hopefully someday. But I think that's, and then to your point about the How Group, and obviously you have the experience, especially in the Philly submarket. For those investors that are listening to this, that all that sounds great, guys, but I'm just so busy in my W-2 job. I just don't have the time. I don't want to manage property, but I want to diversify, right? I want diversification for my portfolio. Looking to a group like yours, where okay, well, this is all we do. So if you're interested in investing in real estate, but you don't want the hassle of it, come talk to us. We can raise some capital, take some money, and we'll go invest it into real estate, and you'll get a passive return. So I think it's not a one stop fits all. It's what's best for you. So um, what do you guys primarily invest in? Are you doing more ground up new construction? Are you still doing maybe now larger multifamily? Are you going into other asset classes, maybe like self storage or industrial, office space at all? Like what's your niche? What do you like right now?
So great question. And because I think that you have to assess the market, and the market is always evolving in terms of what you're going to do. So we have a property management company, we have a development group, we have a construction group. So to feed that engine, ultimately, what we'd love to be doing is buying land and building value added apartment buildings, right? Like at the end of the day, that in our ideal world is what we would do. But market conditions are such that that's not a good investment right now. So, it was this very simple rule of thumb. If I can buy an existing building for less per unit than it would cost me to build the building, I'm buying below replacement cost, right? And I don't have to take the risk of building. and I don't have to wait the 18 months to go through that project. So anytime the market conditions are such that I can buy an existing building for less than it would cost me to build that building, I should be buying existing buildings. Okay. So we are buying existing buildings right now. We're looking for existing buildings where there's some opportunity maybe to be creative and do some things. So, like, we'll buy an existing building that has excess land where maybe we can build some additional units. We bought a couple of those. The other thing that we're doing right now, because market conditions are such that there's not a lot of new construction outside housing being built. Somebody wants to move in and buy a house. There's not a lot of options for them in this market today. So you have a very supply constrained market for new homeowners. So we have stepped into a market that we weren't in before, which is we're doing out sale properties where we're building, by way of example, a 169 unit project of townhouses and stacked duplexes. Um, and you might ask, well, why are you doing that? Everything that I do is about protecting our downside. And so I'm building these out sale products, but I know if they didn't sell, I could rent them and cover my mortgage. So we build out sale. They're doing extremely well. That gives us capital to go out and buy more buildings that we want to hold on to long term as apartment buildings. But right now, our focus is on buying existing buildings that have a little bit of value add to them, or buying land that we can develop and sell to end homeowners.
Yep, makes sense. Is there a specific criteria your team uses to evaluate and ultimately make an offer on a property? For example, I'm not looking at anything built prior to 1980 for a number of reasons, right? The deferred maintenance, probably the biggest one. Or I'm not looking at a property unless I can get it for a 10% cash on cash. Or I'm not looking at a property, to your point, unless there's some value add, which typically would come from under market rents, or maybe there's an opportunity for you to add coin op washer dryers or add some self storage on the property, right? So what is your buy criteria for those that are listening?
Yeah, so the multiples that we're looking at is whatever we buy, we need to be able to get it to a 7 to 7.5 yield on the capital put in. So if I put $1 million in, that needs to make $75,000 a year. And if it does, when I go and take my mortgage out and do the stuff that we're talking about over a 5 year period of time, that building is going to return to an investor, 2 to 2.5 times their money, and they're going to end up making 15 to 20% on their money. If I can get to that metric, which is build to a 7.5 yield on cost, that's the metric that we're really looking at.
So would that be any different than like a 7.5 cap rate, buying it at a 7.5 cap?
It's the exact same thing.
Okay, yeah. So you're buying at 7.5 cap rates. How about we'll stick to the multifamily asset for now. Are you, is there any vintage that you're looking at, 1980 and above, or minimum two doors per unit because of the rental potential? Anything like that?
Yeah, I mean, typically right now we wouldn't buy anything sub 50 units. Our buy box is we'll buy something that's 20 units and it's a really good asset. But typically 50 to 150 units is above what the guys coming up can buy, but too small for the institutional buyer. And that's kind of that buy box that we want to be in, 50 to 150 units that we can get at a 7.5 cap rate when we're finished doing our little bit of work to it. I don't have to buy in day one. I have to get it to a 7.5 by the time I'm done doing whatever programming I'm doing. And the reason that is that asset's probably worth a 5.5 to 6 cap. So I'm creating a 1.5% spread, and that's enough to make some real money on a real estate deal.
Yeah, makes sense. And when you're buying these properties, let's say at a 7.5, 8 cap, you're going in, you're adding value. Are you doing, when you're buying them, are you using, institutional financing, or you buying them through, money you're raising from your database and some investor clients? And then are you exiting in a like almost like a syndication type structure where you're exiting in 3 to 5 years to meet those investor returns? Are you buying these deals at good enough prices where you can do a cash out refinance and not only pay back your investors but also keep the deal?
Yeah, so another great question. We're looking for investors that want to own real estate long term.
Yeah.
So we more look at a 10-year horizon and the 5-year horizon.
Okay.
We're looking to buy good quality real estate that we'd like to own forever. In the past, if you look at our track record document that I sent you, you'll
Yeah.
see that we've returned everybody's capital because we were buying deals and interest rates kept going down and going down and going down. And that was an environment where you could do that. I would never sell anybody today on the idea that, hey, you're buying into my deal and I'm going to refinance it. And we're going to pull all of our capital back out and I'm going to give it back to you. What I say is, hey, look, we're buying based on the assumption that we can do a deal at a 6% interest rate today. Okay. If we're lucky and rates go down, well, there's going to be a huge capital event. We're going to be able to give everybody a bunch of capital back and this deal is going to be fabulous.
Yeah.
And that's going to be hitting a home run. But if you're getting involved in a deal with me today, I can tell you I am boring. You're going to invest in what I hope to be good real estate. You're going to average 7 to 10% on your cash over the period of time that you have it. And when we sell it at the end and you take all your money back, you'll have hopefully annualized somewhere between 15 and 20% on your money for the time it was invested in our deal because
Yeah.
we created some equity and some value in there.
Right. So now, how do you handle probably a common question you get? Gary, I'd love to invest with you, but I don't know if I can, tie up my money for potentially 10 years. What if I want to pull it out after 2 or 3 years? Is my capital liquid at all, or do I have to wait till interest rates to go down so you can eventually do a cash out? Or, when can I get my money back if I needed it?
Yeah, so the simple answer is you can't.
Okay.
Until
Yeah.
we at the development end decide what we're going to do with the deal, that it's not a real liquid asset.
Right.
So if you're investing with us, you're investing for the long term, you're investing in cash flow
Hmm.
because everything else that was projected in the deal is subject to market conditions. If interest rates go up, that's going to change cap rates. It might not be a good time to sell. If interest rates go way down, it's going to affect cap rates the other way. It might be a great time to sell and make a bunch of money. But if you invest with me, you should invest with me because the cash flow that the deal is generating on a year by year basis is something that you want, right? Like I am looking for the investor that says, man, I have this capital. I want to own real estate that pays me a check every quarter. And I know my asset's going to go up in value and I'm getting a dividend every quarter and that's tax advantaged. And this is
Yep.
one. I don't know how else to get this set of circumstances. Like, hey, I could invest in a bond by way of example, but that bond is making 4% or whatever it's making. And then if interest rates go up, well, now I'm making 4% and the market's paying 6.5. Well, I'm still 4%. I'm stuck. Well, if you invested in real estate and those rates go up, generally rents are going to go up. And now you have this inflation hedge where what you make is going to go up because I'm going to lock the debt up for a long period of time, 7, 10 years. So if interest rates go up on us, it's not going to affect our real estate deal. All that's going to happen is hopefully rents will go up commensurate. And now you have an interest rate hedge, and what was making you 6 or 7% might be making you 9 or 10 now. And you
Yep.
and all tax advantaged, by the way, right?
Yep. Love it. That's the beauty of real estate. I wish, more people talked about it. It kind of jazzes you up, right? So one question I like to ask, everyone that comes on the show here is, what does your day to day look like? I'd like to know that, and if there's anything particularly do, maybe wake up, go to the gym, or like, how do you structure your day to be as successful as you are? And if there's any, books that kind of motivated you to get where you are now, whether they're business, professional, spiritual, just, I'd love to know a little bit about that.
Absolutely. So, on the structure of my day, I think there's two things that are super influential. One is I do work out first thing in the morning when I get up almost religiously every day. Without it, my mind goes too many places. And yeah, I need to get that energy out first thing in the morning.
How early we talking?
I usually meet my friend at the gym at 5 o'clock in the morning, so I'm getting up at
Ye-
4:15.
Yeehaw. Okay. Yep. Okay.
Now that is Michael a little earlier than I would normally go, but my friend that I lived with is a nurse anesthetist, and he needs to be in work by 7 o'clock, and
That's fair.
so we got to be in the gym by 5, so we're done at 6:15.
Yep.
So um, I typically do that. Two other seminal things for me that changed everything in my life. One was I joined a group called GoBundance. I don't know if you've ever heard
Yes,
of
I
GoBundance.
have. I got a couple investor clients in it. They love it.
Yeah, so I joined 2014 because they were doing cool trips and stuff that I thought looked like fun that my wife wouldn't want to do. That's why I joined. But they have pillars around health, they have pillars around financial freedom and literacy, how to be a better family man, how to give back to the community, things that are important to me. So I get to be around other people that have the same things that they want to accomplish in life that I do. And then finally, I operate our business office system called EOS, which I don't know if you're familiar with it. It's the entrepreneur's operating system. It's designed for companies that want to grow, to put a real framework around your meetings, your 1 year goals, your 3 year goals, your 5 year goals, and how to hold yourself and your group accountable to those things.
Hmm. Interesting.
So, working out, joining like minded individuals and masterminding, and then having a system that we work off of EOS.
Yeah. So as far as what does your day look like after you get home from the gym? Do you go into the office? Do you work from home? Um, family time. How do you structure that? I'm time blocking certain hours of the day to focus on certain things, whether it's investor calls or I'm muting my phone to focus on these types of things. So how does that look for you?
So the one thing that's a non-negotiable for me is once a week I have a meeting with my leadership team. That's an hour and a half every Tuesday at 9:30. So that's the only non-negotiable thing on my calendar.
Yep.
Other than that, I do time block twice a week for 4 hours, where I will sit down and work on whatever it is that I need to work on from a strategic level,
Hmm.
and then the rest of my days are kind of as needed. I am typically like I'm at events at night, so I'd love to tell you that I figured it out and I work 20 hours a week, and I got this great system that makes me super efficient. But the reality of it is, you know, I'm gonna say yes to a lot of things, guys, which is probably not great. So I'm on a lot of committees. Involved with nonprofit organizations. I'm involved with the local business industry association. So, like 3 nights this week, I'll be out at different events and things that I need to do. And so that means I got to coordinate my stuff during the day. That's my personal stuff. And so I have a lot of flexibility in what my day looks like on a day to day basis. But I'm working 50 hours a week. There's no question.
Yeah. Yep. So your original goal was 10 properties by age 45, no debt on them. You guys are up to 500 million in assets now. When are you hanging it up?
So hopefully the answer is never. My goal is to, in the next year to two, turn over the day to day operations of the company to a core group of people and move more into an advisory role within the company. And I believe that by following the ALS system and cultivating the people that have worked for us, I have a lot of people that have been there 15 plus years with us. They're ready to take over the reins. They want to do it,
Nice.
and that's my plan.
Awesome. Yeah, never, that's it's a good plan to have. Well, Gary, I really appreciate your time. Thank you so much. I know the listeners will get a lot from this episode. If you want to learn more about the How Group, we'll link their website to the show notes. I have, Gary, your track record here, so we'll share everything in the show notes. And yeah, thank you so much. Really appreciate it.
Yeah, it's my pleasure. Can I give you one little tidbit before we go, if it's
Yeah,
okay?
of course, of course.
All right, I got 30 seconds. You told me half hour, so I'm looking at it. But when I think of investing in real estate and somebody were asking me, I think of it three ways, right? The first thing is if you have the time and the capital to invest and you can control the real estate yourself, you should do that. That will make you the most money. There's no question about it. If you want to take the least amount of risk and still be involved in real estate, then you should buy into some of the REIT funds that sit on the market. That's kind of the second option, right? And the reason you would do that is, a REIT is typically, for lack of a better term, they're going to buy 100 units, right? 20 of them are going to be home runs, 20 of them are going to stink, and 60 of them are going to be in the middle. And if the market average is 8 to 10% over 10 years, the REIT's going to average 10 to 12%. You're going to get a 20% premium on your money. You're going to own real estate, and you're not going to have to do any work. Okay? That's the second place I would go. Then, if neither of those two things were exciting to me and I wanted bigger returns and I wanted dividends every quarter, then I would go to that syndication model that you're talking about. But for that, because you're typically investing in a one-off deal, well, now you better far out return to 12%, or it's not worth your while, right? Because you're taking more risk. Because if you put your money into one deal and then that deal doesn't go well, there's a chance that you're going to lose your money. So then you've got to say, well, I need to make 15% on this money. Otherwise, it's not worth it. So if I were thinking through the buckets of investing in real estate, do it yourself if you can and you have the time and the money. That'll get you your best outcome, the most control, and probably the most profitability. If you're not interested in that and you want the safest way to get a little better return, go into a REIT. If you're young and you're aggressive or you want a higher level of return for a little bit more risk, then you come to guys like me that do syndications and do deals like that, and then we can offer you an opportunity. So I just like to have that framework out there for people. So when they think through it, they go, oh, one of those three makes sense to me. And there isn't a right one for everybody, but you'll know immediately which of those three sounds the most enticing to you. And then it makes it easier to make decisions.
Yeah, no, I really like that. It's clear, it's simple, and you can actually make a actionable plan from that. So thank you. That's really good. And again, thank you for your time. Really appreciate it. And we'll be sure to link all the show notes so people can learn more about you and reach out anytime.
All right, awesome. Thank you so much for your time.
Take care, Gary. Bye. Thank you for watching Sky's the Limit. We're always releasing new real estate content, so if there's something you want to hear, be sure to leave a comment. And don't forget to subscribe to our channel.